Good afternoon and welcome to the International Dairy Productivity Analysis event. I'm Jane Foster from ORM and I will be your host for today's broadcast, brought to you by Dairy Australia. We have a stellar lineup of presenters today. Before we say hello to them, it's my pleasure on behalf of Dairy Australia to welcome Helen Quinn to welcome you all today. Over to you, Helen.
Good afternoon and welcome to today's webinar on international dairy farm productivity. My name is Helen Quinn and I am the head of economics, data and insights at Dairy Australia. Firstly, I'd like to acknowledge our farmers who are dealing with floods in northern New South Wales and drought in southeast Australia. This webinar shares insights from the International Dairy Farm Productivity Project, a 2-year collaboration across Australia, New Zealand, Ireland, with the results coming soon, and the United States. Rising dairy farm productivity is crucial to the long-term success of the dairy industry. However, weak performance in Australia and New Zealand raises important questions about the drivers of productivity and how the industry should respond. Today, we're joined by leading economists, Gavan Dwyer, Mario Fernandez, and Chris O'Donnell, who will cover the limited impact of technical progress on recent productivity growth, the role of technical efficiency, as well as scale and mix efficiency, how strong terms of trade have supported profitability, and what countries have in common, where they're different, and how research and development can help improve the industry's future performance. I hope you find today's session useful for you and your farm business. Thanks, Jane.
Thank you, Helen, and for that introduction and background. Now, before I move into introducing our guest presenters today, I would also like to draw your attention to the Q&A feature on your screen. Now, you can use this at any time during the session to ask a question. We will be taking a selection of audience questions through the session today, and while we'll endeavour to cover as many as possible, those we can't answer during the event will be addressed after the close of the session. Now to welcome our guest presenters for today in order of appearance. So I welcome Gavan of Marsden Jacob. Good afternoon, Gavan.
Great to be here, Jane.
And we have Mario Fernandez of Dairy NZ. Welcome to you, Mario.
Glad to be here today.
Great. And Chris O'Donnell from University of Queensland. Great to have you with us, Chris.
Yeah, thanks, Jane. Hello, everybody.
Now, I know you are all looking forward to getting into the session today, but firstly, for those watching who may not have met you all before, I'd like to call on yourselves to introduce yourself to the audience. So firstly, we're going to kick off with you, Gavan. Over to you.
Yeah, thanks, Jane. Nice to be here. I'm from a multi-generational dairying family. I've worked in agricultural economics for about 35 years, been consulting for about 10 years, and doing quite a bit of work in the RDC community. Prior to that, I was Chief Economist at the Department of Primary Industries in Victoria and various other roles in government over the years. So that's me.
Perfect. And Mario from New Zealand, over to you.
Hello again. I'm Principal Economist at Dairy NZ, an industry-good organisation that is dedicated to research, advocacy and support for the New Zealand dairy sector.
Lovely, great to have you with us. And Chris, we'll come to you now. Let you say hello to the audience for today.
Yeah, thanks, Jane. So I'm Chris O'Donnell. I'm a Professor of Econometrics at the University of Queensland. I'm also a former editor of the Journal of Productivity Analysis and a former editor of the Australian Journal of Agricultural and Resource Economics. That's where my main research interests lie, at the intersection of productivity and agriculture, and I'm very pleased to be given the opportunity to join you today.
Yeah, well, we're very excited to have you all with us today. Now, with those formalities completed, let's get right into the session. And firstly, why productivity? Gavan, it's over to you.
Thanks, Jane. Let's get moving. Look, economists have talked about productivity for many years. It's central to how they think about the world because it's one of the key things that drives our prosperity in the future. And why they're interested in it is because it's about deep long-term trends. It's almost like the tide that rises over time. We're not really interested here in the short-term waves that crash to the shore. So we're really interested in it from a long-term perspective because it's essential for prosperity. When we start talking about productivity, it's really important to just think about some core steps here to make sure that we get to the end point of being able to be meaningful about it. The first is that we need to be able to measure it appropriately. We need to be able to define it appropriately. We need to be able to apply appropriate tools and techniques to understand its composition, and we need to be able to think of it from a policy perspective. So what are the things that we should be doing to change? Okay, so
composition of productivity.
Yeah, when we think about the composition of productivity, we often start with the idea that in agriculture, people often confuse terms. So they often mix up profitability and productivity. What we're really interested in is productivity because it's about this idea that we can produce, it's the idea of how much output we produce with given inputs, whereas profit is how much, return we get at the end of the day once we take all of our costs out. And profitability is the rate of change in profit over time. Now, profitability has really strong linkages through to productivity. First up, profitability is made up of the productivity effect as well as the terms of trade effect. So when we're looking at productivity, the important thing is to be able to break out the composition of that and understand really what's going on there. First up, we've got the technical progress effect. That is, as we progress over time, we can make more progress in how we produce output for given inputs and so forth through. We also think about it in the terms of technical efficiency, and that is how good we are at adopting and applying those technologies and making the most out of them. The third is the scale effect and efficiency effect, where how big you are can matter and how good you are at being able to alter the mix of those outputs to those inputs also matter as well. The other really important factor when we're thinking about profitability is that the prices we receive and pay for goods and services really matter as well. They're an essential part of our overall profit equation. So understanding how that's changing over time is really important. So what this work fundamentally does is try to unpick that over time. We'll just move to the next slide. Okay, so I've talked through these core concepts in a brief way just now, but what we've done is we've developed up some very sophisticated statistical tools through the methodologies we've used to be able to do this. One of the essential ideas here is that we're taking detailed farm financial data and being able to convert them into these measures of output and measures of input and those price effects, and being able to see how farmers vote with their feet over time. And being able to understand these compositional changes in productivity, such as, well, how much technical change are we achieving? Well, they're driven by our ability to find and implement new technologies over time. Our technical efficiency is how well we are going at being able to achieve that. So how close are we to what those possibilities look like? But we also have got to take into account, as after we take into account scale effects and so forth, there are also other factors out there, such as environmental effects, what the climate's doing. And as we know, everyone's under very difficult circumstances at the moment. It's obviously having some very important short-term effects on productivity. Once we take those longer-term effects out, we're really interested in what those underlying trends in productivity growth look like. We'll move to the next slide.
Well, I think actually, Gavin, just pausing there for a moment, that's really great. You've set the scene for us today in terms of helping the audience understand a little bit of the background and context of the work that's been done. But now we're going to move on, and we're actually going to get into some of the Australian numbers. So now to Australia and what we've found. To you, Gavan.
Thank you. Let's move on. If we can move to our next slide. Okay, so we've talked about how productivity growth is really essential for long-run competitiveness. The insights we have from our work is that Australian productivity performance has actually been relatively weak over the journey since about 2013-14 through to today. It's been generally weak across most regions. Tasmania has been an exception where we've seen some growth, albeit not as strong growth as we would probably like compared to some other international standards. Nonetheless, it's there. We did some previous work that measured up to 2019, and in our recent work here, we've updated that beyond 2019 through to 2023-24. And those trends that we saw up to 2019 have really actually been reinforced with a general weakness in productivity. But it's also reflected in high performance through, in terms of our profitability through international prices, and we'll take a look at that. There's some interesting dynamics there when it comes to productivity, that there can be this subtle paradox that as our terms of trade improve, that is, as prices improve for the goods that we receive, but relative to the prices we pay for our inputs, that can sometimes mean people take their foot off the pedal a little bit with how they push their inputs relative to their outputs. And that can lead to a weakening of productivity. So we'll talk about that. And we need to remind ourselves that R&D is actually really essential to one of the solutions to productivity performance over time, along with a number of other factors, and we'll talk about those in a sec. We'll move to our next slide. So this is a graph that shows us that performance of productivity, which is our dark blue line, over time, relative to what's been happening with our profitability index and our terms of trade. So we're seeing that our profitability has been rising, and rising quite substantially since 2013, 2014. But we see it very closely linked and tracked to the terms of trade. So what's that telling us? Well, the terms of trade are having a substantial effect on our productivity, on our profitability performance. So we've been receiving relatively better international prices for a period of time, particularly since 2018, 2019. Well, since 2018, 2019, there's been some movement before that. But we are seeing this general weakness in productivity performance relatively consistently. We did have a drop in our terms of trade for a period there around 2015, 2016, 17 that many people well remember and don't like to remember. And during that period, we had a slight kick up in productivity, but nowhere near the level and growth that we'd really like to see as a reaction to that. So maybe there's a few factors going on there that we really need to understand. We need to understand that it a period of difficult time when we had COVID as well. So there's a variety of factors to try and unpick, and we'll try and do that in our next couple of slides. So we'll move to our next slide. Okay, so when we think about productivity, just providing a result for the entirety of Australia smooths out a whole pile of other things going on across various regions and various states. In our work that we've done, we've broken this down to detailed dairy regions as well. So there's more detailed information that you can go and have a look. But across the board, we're seeing a relative level of consistency in that of a systemic weakness. There are a couple of differences. We can see Tasmania in that grey line jumping up and improving, but they're still relatively small levels to that index. We're also seeing some improvements in South Australia, but we've got to treat them with caution. South Australia, in the way that data is set up, is relatively, there's quite some distinct differences between the different regions within South Australia and some of the things going on there, and also maybe some issues in the data with the number of farms that we might have in that set. So we're going to treat that with caution. But we can also notice that there are some distinct differences there between some of the different states. For example, Victoria tends to have a higher rate of productivity performance, for example, compared to some of the other states, which is a relatively well-known phenomenon over the recent journey. We'll move to our next slide. Now we're going to break out those ideas of productivity and understand them a little bit more. What we see is no single factor really doing the hard lifting around boosting productivity growth. We see some volatility in our mix efficiency and scale efficiency over time, which is quite interesting. And I think we need to do more work to understand that, because not only does it affect productivity, it also affects profit, and it can do that in different ways, and in ways where they don't move consistently. Probably one of the important things for us is to understand that technological change, that blue line, has been relatively flat over the entirety of the period. When we do statistical analysis on that, it's really hard to see a lot of movement in it. And we'll talk about what might be going on there and some paradoxes that are probably on our mind. Secondly, we know that technical efficiency is also flat. But when we do statistical analysis on that, we also find that it's relatively very high. Farmers are actually really good at doing what they do relative to the frontier of what's possible. Well, in some respects, first principles, there's no real surprise with that, probably, because we know over time there's been large adjustment in the industry. So, weaker farmers exit over time, better farmers stay, and to stay longer, they've got to get better. So technical efficiency seems to be pretty good. From there, I think we're maybe on my last slide. We'll move to the next slide.
Actually, Gavan, I think it's back to me. So thanks so much. A lot to digest in that information that you just presented. But I think it's a really great opportunity at this point. We'll invite Mario to the discussion, to hear what our neighbours in New Zealand are seeing across their industry. So over to you, Mario.
Hello, hopefully my mic is working properly.
Yeah, we can hear you perfectly, Mario, so
yes.
Fire away and
Sure.
Take it from here.
Thank you. My presentation is for the New Zealand case, so I will proceed with the clicker. Yep. Now, why does productivity matter for New Zealand dairy? And it is because New Zealand is punching above its weight in global dairy markets, exporting about 96% of production, despite the smaller volumes compared, for example, to the US or Germany. And this export orientation means the competitiveness depends on how well the sector performs internationally, how it handles market volatility, and how it responds to climate pressures. All these elements rely or directly associated to productivity growth. Now, our approach is similar to those used in Australia and the US, with some differences in the environmental variables that we have used and other details that we can discuss at some other time. We use data from Deribase, covering 739 farms between 2013 and 2022 seasons, making an unbalanced panel of 2,426 observations. What matters here is, and what I emphasize all the time, is that behind all these numbers, behind all our modeling and findings, there are real people making real choices. So our TFP index, it just reveals that there is a decade-long plateau in productivity growth. And as we contrast this to the behavior of our profitability index, what immediately catches our attention here is the plunge in 2015, 2016, due to the record payouts drop. But thereafter, despite some fluctuations, that profitability index recovered. Now, and the pattern is unmistakable when we introduce the terms of trade index. Profitability closely tracks this index, showing the overwhelming influence of prices on profitability. And since volatile prices are beyond the sector's control, any benefits from high payouts may be short-lived. This makes productivity improvements, which farmers can actually control, crucial for cushioning volatility and driving profitability in the long run. Now, as Gavan was mentioning, there is a lot of value when we decompose our TFP index in order to understand what is going on behind the scenes. And we have here for our technological progress index, it increased by 6%, but it has plateaued after 2015-16. That is what we could say here is that new technologies are not necessarily translating into productivity gains, and we have to investigate these. Reasons for this likely related to implementation costs of those technologies, insufficient adoption, or environmental compliance focus rather than on productivity. as we see what's going on in the production environment, we have another index for the environmental, for the production environment index, as I was saying, showing a persistent drag because there is a drop after 2013-14 without any recovery. However, the flat trend here suggests the sector adaptation and resilience. Even though there was a drop, productivity has remained relatively stable, showing the commitment of farmers to keep producing despite all these environmental challenges. And these are the key or priority drivers of our investigation for the next year. But we also have other indices that we must, for completeness, we also have to investigate. This is for the scaling input mix efficiency. Again, another flat trend, suggesting that farmers' efficiency to select the right inputs conditional to the circumstances has remained unchanged for over a decade. About technical efficiency, we can say that there's also another flat trend, suggesting that farmers are already efficient on using existing technologies. And lastly, the statistical noise. This is pretty much saying that our approach is a reasonable reflection of performance and consistent with historical observations. Now, understanding the dynamics of productivity across regions is crucial for shaping investment strategies. It is crucial for targeted policy advice. And that is where this kind of work also adds value. And here we are examining 3 of the 8 New Zealand dairy regions where findings are nuanced, but all the plateaus persist. We have there our national average. And interestingly, we can see here as an upper bound for our results is Canterbury, the TFP for Canterbury, a dairy region characterized by intensive, high-tech irrigated systems, superior per cow production, outperforming the national average by 30% in most of the seasons for which we have run this analysis. At the same time, we can see how Waikato is behaving. It is a country's dairy heartland in the central North Island. It is the largest region by number of cows and land on dairy and shapes the national average. But here's where things start to get more complex than usual. Northland, the strategic challenges that we have for this region, because at TFP, the performance is about 25% below the national average, the lower bound for our results. Driven mainly, and this is in agreement or aligned to past work, here there is said, climate impacts, widespread kikuyu grass, which is a subtropical species with poor nutrition and high seasonality, demanding costly feed imports, grass integration, and other actions that reduce overall efficiency. Then, while Waikato and Canterbury, they may show a relatively stable landscape, Northland is fighting a battle against its own environment, and we'll get back to this in a couple of minutes. Thank you. Back to you, Jane.
Thank you, Mario. Great to have you with us to present the New Zealand data, and we see some interesting analysis of Australia and New Zealand and some similar trends there. Now I'd like to invite Chris, and you're joining us here to share from the analysis report by USDA Economic Research Service, and that was authored by Eric Dukey. You'll be helping us by drawing out some observations in regards to the US dairy industry. So over to you, Chris.
Yeah, thanks, Jane. So I was asked to present some of Eric's work because I've been providing him with some technical advice on his productivity work over the years, and we're currently working on another project that's related that I'll get to later. But I'd like to start by just telling you a little bit about dairy milk production in the US. It's mainly concentrated in a fairly small number of states in the West, Southwest, Midwest and Northeast. And in many of those states, dairy is, well, it's the biggest game in town. You know, the cash receipts from dairy in those states are greater than the cash receipts from any other agricultural commodity, so it's big. But the structure of the industry has been changing. In the last couple of decades, there's been a shift in production from small to large farms. The size of the national herd that's increased slightly. At the same time, the number of farms has fallen by about 40%. Large farms, that's, you know, farms with more than 1,000 dairy cows, they now account for more than 50% of the national herd, which is up from about 30% in the 2000s. The thing about these large farms is that they tend to specialise in dairy production, and as I say here, they're fairly quick to adopt new technologies, robotics, biosensors, drones, all that sort of stuff. Smaller farmers, they are slower to adopt those technologies because of cost. Some of these technologies are costly to install and maintain. Farmers need to be trained. And so that puts a bit of pressure on profits. The last couple of decades has also seen, higher frequency of, extreme temperatures and floods and droughts, things that we've witnessed in Australia as well. These unfavourable environmental conditions, they reduce the yield of feed grains, they've lowered the quality, the availability of pasture and forage, they've damaged the normal functioning of reproductive health of cows, they've increased the distribution and the resilience of parasites and pathogens that affect animal health, all bad for milk production. And together with, rising production costs, that's put enormous pressure on profit margins. Well, economists will tell you that, this pressure can be relieved through technical progress, and if farmers are not already adopting best practice, improvements in technical efficiency. Now these things also drive higher productivity. But that doesn't mean that, profits and productivity are always going to move together. There are other factors that push profits and productivity in different directions. And that's why we need to know more about the factors that have been driving productivity change. So what does Eric do in his report? Well, in view of the fact that production has been shifting from small farms to large farms, Eric was mainly focused on the effects of herd size on productivity. And of course, there's many different measures of productivity. Eric uses milk output per cow as one measure. The problem with milk output per cow is that, well, it ignores, all inputs except cows. Often the easiest way to improve milk output per cow is to add other inputs into the production process, better milking machines or feed or antibiotics or whatever. And we really need to take those other inputs into account. And so, Eric turns then to a measure of total factor productivity, TFP. And there's several ways of measuring that. Eric uses a particular type of index that's got nice theoretical properties. Then, of course, what he does is he's interested in how productivity changes. How it's driven by changes in things like technical progress that we've just kind of heard Gavan and Mario talk about, and he uses a particular type of econometric model to do that. So what does he find? Well, looking at milk output per cow, this figure here, it tells us how milk output per cow has changed over time for different breeds of dairy cow, right? So the blue bars that you see, the big tall ones, right, they tell us how average milk output per Holstein cow has changed over time. The red bars tell us about, Jersey cows. Well, you can see across all breeds, the productivity's been increasing. Milk output per cow has been increasing over time. Taking the popularity of different breeds into account, average milk output per cow has been increasing by about 1.5% per annum, from about 18,000 pounds per cow in 2000 to about 24,000 pounds per cow in 2020. Well, Eric also finds that, herd size matters. Right, so this figure tells us how, milk output per cow has changed over time for different sized herds. So the black bars you see there, they tell us how milk output per cow in 1996 varied by herd size. And if we just look at the black bars, we can see that the highest black bar was for herds of, size 2,000 to 2,999, big. And the light blue bars, right, on the right-hand side of each block, they tell us the story in 2019. And we can see that the highest blue bars are for herd sizes in the range 2,000 to 3,999. This figure is telling us that average milk output per cow has always been higher for the highest, for the biggest herds. Well, it matters for TFP growth as well. So what this figure tells us is it tells us that the average rate of growth in total factor productivity has been highest for the bigger herds at nearly 3% per annum. For herds of less than 100 dairy cows, average rate of growth in TFP has been only 0.64%. Now, we need to be a little bit careful here because, high rates of growth don't necessarily mean high rates of productivity. And that's because we don't know the starting points. For example, if small herds had been significantly more productive than large herds in 2000, then the high rates of growth we're seeing in the large herds might simply mean that they're catching up. That said, my knowledge of the way Eric's put together the TFP numbers, it tells me that the TFP numbers are going to be fairly highly correlated with milk output per cow. And so I think it'd be fairly safe to conclude that, TFP of large farms is significantly higher than the TFP of the small farms. Now, when it comes to the drivers of productivity growth, right, the left-hand panel on this slide tells us what's been happening to TFP growth for small farms. The right-hand panel tells us what's been happening for large farms. Now, the dark blue bars that you see there, they are the same as the dark blue bars I showed you on this slide, right? So on the left, you've got, small farms, 0.6, whatever it is, and on the right, you've got the large farms. They are the blue bars, the dark blue bars you see here. And what the bottom legend is telling you, it's telling you what all the other bars mean, right? So the blue bars, they measure TFP change, TFPC. The red bars, they measure TP, technical progress. And it's clear that, technical progress has been an important driver, hasn't it, of TFP growth for both small and large herds. The light blue bars measure the scale and mix efficiency change, SMEC. This has been a drag on productivity growth. The yellow bars, they measure TEC, that's technical efficiency change. That's also been a drag on productivity growth. And the other bars, they represent environmental change, EC, environmental change effects. They're the changes in temperature and rainfall and other factors that affect, the availability of feed and the health and well-being of cows. So what are the implications of those results? Well, they tell us that technical progress has been the main driver of productivity growth. Well, technical progress comes through a process of research and development. So if governments want to maintain or increase rates of technical progress, they need to, conduct more research and development themselves, through, CSIRO or whatever. They need to provide more funds for other people to conduct research and development, through research grants and so on, or otherwise incentivise other people to conduct more research and development by, changing laws governing intellectual property and patent expiry dates and that sort of stuff. Now, in periods of rapid technical progress, you can in fact expect levels of technical efficiency to fall. Farmers are not going to be replacing a milking machine with the latest model every year, right? They're only going to be adopting the latest technology when they end up so far below best practice that they start to become uncompetitive. And so it is in US dairy, where technical inefficiency has been a drag on productivity in the presence of high rates of technical progress. So, if governments want to increase technical efficiency, they need to, remove barriers to the adoption of certain technologies, be they regulatory barriers or financial ones. Sometimes it costs a lot of money to adopt a new technology. And so, some technologies may need to be subsidised. Or, they need to provide education and training to farmers about the existence and proper use of new technologies. That is, they need to provide extension services. And also competitiveness is important, right? Ensuring markets are competitive is one way of increasing technical efficiency. The other thing we see in the US results is we see that diseconomies of scale and substitution have been a drag on productivity. Well, that might just be because economies of scale and substitution can lower profits. And my guess is that the US results are due to the fact that farmers are more interested in profits than in productivity. But until we get a better understanding of the relationship between profits and productivity and prices in the US, I'd argue that, government policy should, take a back seat in that area. If the governments did decide to take action there, then they'd be looking mainly at price policy. Farmers are going to change the scale of their operations and they're going to substitute some inputs for others as governments change prices. That is, as interest rates change, as minimum wages change, taxes, subsidies, and, dare I say it, tariffs as those things change. Well, I think I've probably run out of time, so I think I'll leave it there. Back to you, Jane.
Thanks so much, Chris, for bringing those US results from their report. That certainly adds a very international flavour to our conversation here today. And now, in terms of that, Gavan, we're coming back to you. There is some context for Australia in terms of the US story that you are going to take us through now.
Yeah, thanks, Jane. Look, the US and Australian story is actually really quite interesting to dig into. Probably one of the first observations I'd make is one of the interesting things going on in the US is the development of greenfield sites for dairy. So we're seeing really large, very, very large-scale dairies being developed up in a world where, you know, they've got low construction costs, they're able to access water in a less regulatory environment, access to relatively cheap labour, and some of the regulations around what they can and can't do can be quite different and freeze it up. So we're seeing a lot of growth in those really big greenfield sites where they can just come in and almost immediately develop a swish watch effect and get those dairies really working and humming. The other interesting jump-off point here for us to think about from the US perspective is Chris raised how large the US dairy industry is. It's enormous. It's large, but it's also got a large population of people consuming those products. What's interesting is you only need a relatively small change in production in the US to then have that spilling over into export markets, which then depresses world prices. So one of the big issues I think we need to keep in mind as we go forward over the journey is continuing high rates of growth of productivity in the US have important implications for us with our terms of trade. So it will have a tendency to dampen them. But also there's the idea that it will probably have influences on its volatility as well. So we've got to be really careful about that because productivity is a really important insulator against those weaknesses and volatility in terms of trade over time. So we've really got to work on trying to improve that. And, you know, some people have turned around and said, well, you know, gee, you know, the US is really performing extremely well. Why can't we just do that? Let's all just get big. Well, first up, it's really hard to implement that swish watch effect. And that's really hard to execute in Australia. Some are doing that very well, but across the board at the scale that the US is doing it, we haven't seen that, and it's very hard to do. So we've got to probably work at probably better adopting and implementing those precision technologies at that scale. We also need to remember that it's not for everyone, and we can't all do it because, you know, would we be able to do that at a cost-effective level, given some of the constraints we place with labour costs and other costs that we face in our country. So extensive technologies are going to be really important to continue to work on because there's still going to be a really important role for pasture-based systems going into the future. So we've got to find and develop up those technologies where we can't implement them and just pick them up off the shelf from other countries where we're not seeing those investments being done. So we've really got to work on that. I'll also just turn a little bit to this idea that big can be beautiful, but it's not for everyone, which is kind of what I've talked a little bit about. Now, I think Chris has already talked about how scale can, you know, really drive profit, but not necessarily productivity. And there's some interesting reasons about why that might be the case. And certainly in Australia, there's some evidence from what I can see in the data that we look at that when farmers are increasing their scale, what's also happening is their terms of trade are improving. So they're using that to actually negotiate and leverage better prices. And that's been part of the business model, is to try and get that profit rising through that avenue so I can lock in long-term contracts for milk supply at high prices and so forth. But it's also related to things like being able to, perhaps in some circumstances, better manage risk. Part of the strategy of moving to those large systems is to do that. When we look closely, we're seeing more evidence of that in the data that we look at, and that could be an artifact of the data set, but we're seeing more evidence of that, and in Tasmania, more evidence of it being successfully implemented. So there's a couple of observations there. I'll move to the next slide. There's also this paradox that comes to people's minds when we talk about productivity and we're going, well, technical progress doesn't seem to be lifting it much. People go, what's going on here? You know, everywhere we look, we see technical progress. We're seeing new tractors. We're seeing, rotary dairies going in. We're seeing automation, all sorts of technologies being implemented. What's going on? Why isn't our productivity growth going up? Well, sometimes that technical progress can lead to increases in output, but by the same token, we're also increasing our inputs to do that. So to really lever those extra increases in output, we know we can actually push that a bit harder if we push those inputs a bit harder. And in some of those systems that we've talked about, that's worked really well when we've been able to get those higher prices as well and leverage that terms of trade. So we've got to remember that effect. We need to also remember that when we go and look under the bonnet, we know we're investing in really good R&D. We know we're getting good benefit cost ratios from post-evaluations that we do of research. So, we know that the implementation is there. Well, is there something going on there about other things that might be led in the saddle? Are we finding that we might be having things that are holding us back? Could it be regulation? Could it be our access to better labour? So that's important to remember. The other factor to keep in mind here too is that we shouldn't think of the glass half empty. We should think of it as half full. We need to think about the counterfactual. Thank goodness we've had all of that R&D pushing along and trying to keep us and push us up. Where would we be if we hadn't have had that? Because of these other factors, there's a whole pile of variety of factors that are impacting upon general productivity performance, and we need to keep building that stock of R&D going forward to be able to make that build that insurance. We also need to remember that farmers are bloody smart people, and they work hard and they work smart, and they're good at what they do, and we're seeing good evidence of that in the data set. So maybe that's potentially an artifact of some of the data that we're looking at, but we also got to remember that a lot of the poor former farmers have exited, so we've got really good ones remaining, and we need to keep in mind that if we have and focus on pushing that technological progress further into the future, we probably implicitly know it's going to get more complex and harder. So what we've got to do is make sure we've got those farmers geared up and able to take on those more complex technologies. Maybe it's going to get harder to do that in the future. So we've really got to, we can't rest on our laurels with our technical efficiency so far. It's been high, but we're going to have to work on it because we could hit an issue there into the future. We'll move to the next slide. So I think that one of the important messages is, and this is not judgmental, it's just saying we can't afford to take the foot off the pedal. It's risky if we go, well, look, terms of trade are doing a lot of the lifting here, isn't that fantastic? It's not saying that we can't do better, we can, but we need to continue to work at it, particularly when we have that volatility in the terms of trade, so that it does bounce back. It's risky if we don't work on it. Our productivity is really our long-term insurance premium against that. We also need to remember, if we've got that volatile world with prices, we also need to remember that there's other volatilities coming in here. And when we measured productivity, we had one of the concepts there that we need to measure and understand its effect on is the environment, climate. Well, when we look at that, when we look at the Australian data, we're actually seeing some early indicators that there's something going on there, that productivity seems to be negatively impacted with some of the volatility and changes that we're seeing in some of the climate data that we have there. We need to understand that better, and we need to understand how we're going to get the R&D solutions to solve that in ways that boost productivity. So, some things will require more inputs potentially to address some of the climate effects into the future. Can we find smart ways of doing that so we boost productivity over time and address that? So we've got to find those new technologies, we've got to find those new opportunities and drive them as efficiently and effectively as we can inside the farm system. We've got to enable farmers to be able to have the capacity and the knowledge and the ability to be able to take them and implement them into their farm system. The hardest thing in any farm system is to take something new into it and change what's working and change what's working well and do that well. So we'll really work on that as well. And we're going to make sure that farmers can do that where they can vote with their feet. Right? Where if they want to be able to implement something that's going to be more successful for them into the future, that we can find ways to be able to do that. So making sure that we don't have inappropriate regulation or other factors, inappropriate policies holding them back from being able to make that choice. We need to remember in this data that we're looking at, this is looking back historically and saying farmers are telling us a message. When we look at the farm financial data and disaggregate that and understand it with the appropriate measures, we measured it consistently, we've used the appropriate techniques and we can compare it. There's something going on that we need to better understand. They're telling us a message and we need to understand how we can divine and work to improve the circumstances for them going forward. Thanks.
Okay, thanks very much, Gavan. So with an eye to the future there. And now we're going to come across to you, Mario. So for New Zealand dairy, what is industry signposting as the key priorities towards meeting the future?
Hello, again. What is the road ahead for us at Dairy NZ? Well, start emphasizing again, New Zealand has the best of conditions to grow pasture, and the sector has taken every advantage in this to shape up its cost competitiveness. Nonetheless, we see that our productivity growth has plateaued, and that requires extensive and careful interpretation. This is something that I was actually discussing with someone last night. The technical side of the project was hard. Conveying the message and doing a careful interpretation is even harder. But Gavan has already described the challenges in the technologies space, the legislation, as described by Chris, that need some level of resolution in order to stimulate a positive trend in productivity. For us, for the economics team here at Dairy NZ, we are taking some steps and we are developing a project called the Competitive Insights. And it starts with, first of all, gathering insights, feedback from farmers about productivity, competitiveness, the priority research questions that require our attention and effort. And this is something that we have been doing the last couple of weeks. Preliminarily, what I can say at the moment is pasture harvest decline or stagnation in Northland, the Waikato, and Taranaki. It is a recurring concern. It is something that keeps popping up in every conversation that we have had so far. Some linked it to climate change, others they linked it to long-term weather patterns, others to a shift towards supplementary feed. In any case, this pattern challenges the very foundations of New Zealand's pasture-based dairy model, defies the very cost competitiveness of our sector. And now we have this conversation as the government reviews legislation on GM pasture, and Dairy NZ is actively contributing evidence to inform this and other future strategies. This is a critical area, amongst others, for policy research and industry response. Likewise, there's also room for improvement on New Zealand's animal genetic gains. There's some relevant work in the last couple of years in the US evaluating genetic progress as a technological change within the same TFP framework. And it is going to be interesting incorporating this approach as part of our future plans, which aligns with the broader efforts to better measure productivity drivers in dairy. And this is another conversation we were having a couple of days ago, is that we have the decomposition, but we have to interrogate the model further in order to get what it is clearly telling us and the additional work that should be done in order to get better answers. Lastly, here in New Zealand for years, we have had this emissions pricing and technologies debate in the air. Fonterra just started a QO payment scheme funded by Nestle to incentivize farmers to reduce emissions intensity. And this is a novel application of a market-driven instrument for environmental goals, where also Dairy NZ we're being active on research and monitoring this prior to its implementation and during its operation itself. Now, getting back to Gavan, this is one of what I could say the greatest advantage of using a total factor productivity approach rather than just relying on partial KPIs or partial metrics is that we can see all elements within just one framework. And we can also tell the story about what did not happen, I underline that, what did not happen. Consider the challenges the sector has faced over the past decade. Payout crashes, climate challenges, persistent droughts, environmental regulations, a pandemic. By all expectations, productivity or the sector itself could have collapsed, but it did not. And this stability is not just a flying line on the graph that I just showed you minutes ago. It is a testament to the sector's ability to adapt and to make smart decisions under extreme pressure. And this is important as we live now in an era where uncertainty permeates every conversation. And based on what we have shown, New Zealand dairy is not only prepared to stay afloat, but to chart the course. But based on this solid foundation, we have to start thinking, what are we going to do in order to do even better? And what has become evident during the past 2 years, during the course of this project, is productivity growth not only cushions the impacts of volatility on profitability, productivity growth fits directly into profitability. And this is just a quick calculation we did. For every 1% increase in productivity coming from technological improvements, from shifting the production frontier, it is going to generate about $52 million in sector profit. A potential that compounds over time and is uninsulated from market volatility. And I think that the dairy sector can do better than 1% a year. And even more, considering the climate challenges that the dairy regions, the whole country is facing and will face in the next decades, productivity growth is the framework, is the artifact on which adaptation strategy can be developed. And all this takes us to the main implication, to the final takeaway message of all of our work. To be competitive, to be profitable, to be resilient, the dairy sector must be productive. There's no other way around. Thank you.
Thank you, Mario. Very strongly focused on the future there for sure. So, Chris, we are coming back to you now. And so kind of in wrapping us up and closing the session here today, you're going to tell us about some additional work around this field. And also there's an invitation you'd like to extend.
Yeah, thanks, Jane. You know, I spoke previously, the US stuff that I was talking about was that was a report written by Eric Juki, and Eric and I are also working on some related stuff. This, you know, the OECD, ministers of agriculture for OECD countries have told the OECD Secretariat that they need to measure what they call sustainable productivity change. Now, sustainable production refers to the production of good outputs in ways that minimise the production of bad outputs. In the case of milk, we're talking about producing milk in ways that minimise the production of methane. And so this is a project that takes farm-level US dairy data and measures productivity in a way that reflects well on dairy farmers that adopt sustainable production practices, and so we do that, and then we decompose these so-called sustainable productivity index numbers into the sorts of measures that we've talked about today: technical progress and efficiency change, and so on and so forth. So that's an interesting project. The other work that you know, Helen's already mentioned that this is an international collaboration. This stuff. The other work that I wanted to mention is work that's being done by the Irish equivalent of Dairy Australia, Chugus, and so we are fortunate that Chugus is funding a PhD student to work on measuring Irish dairy. So there's the measurement thing, right? And then there's also the explaining thing. So this student is also going to be looking at what's driving productivity change in Ireland and you know, doing comparative work with New Zealand, Australia, and the US, with an aim to understanding you know, the policy implications, looking at issues of competitiveness and that sort of stuff. Now, the last thing I wanted to mention is, you know, Gavan, in his introduction, pointed out that, when you do productivity analysis, there's basically 4 things you need to do. And the first thing is define what you mean by productivity, right? There's many different kind of measures of productivity: milk output per cow, total factor productivity, multi-factor productivity, you have to define what you mean by productivity. Then you have to measure it in a way that's consistent with that definition. And then we need to know why the productivity numbers are bouncing around. We need to explain variations in those measures, and we've seen today how that can be done. And then we need to use that information to draw out the policy implications. So for the boffins amongst you, the people who like to get your hands dirty with the numbers and the technical work, I'm running a short course in November on how to do that sort of stuff. And I think Jane was going to put a link in the chat to the website for that course. So thanks, John.
Certainly, Chris. We were going to put a link in the chat. So anyone that was interested will be able to click the link, and it takes them through to the registration page for the 2-day workshop. So anyone interested, head to the chat now and you'll see the further details there. So thanks to you all. That's brought us to the end of the session in terms of the material that you wanted to share with the audience. We do have a few minutes for some audience questions, and you'll be happy to know there are some audience questions here. So what I'll do is take them in order. I'm going to start with one from Scott Barnett, and I think I'll direct this to yourself, Gavan, in the first instant, and then Mario may have some reflections in terms of New Zealand. But Scott asks, with the high technical efficiency in Australia and low technical productivity growth, does this imply that we are reaching the biological ceiling in our grass plus cereal grain system? So
yeah, good question. That's on a few people's minds. There's some people in the US are asking themselves more broadly about technology and, is it getting harder and harder to find new gains? Well, yes and no. There's some idea in the communities that I speak to where some of those incremental gains, you get into diminishing returns. It gets a little bit harder and harder. We're just making smaller and smaller step gains. But equally, we're also investing in new technologies all the time that just fundamentally shift and change the dial. And a few of those have come along already, such as, genomics is maybe a good example of that, with there's work being done in plant breeding along those lines as well. So there's opportunities for new gains to emerge, particularly in the pasture space. I'm sure there's other things out there as well, but the big point is that in the long run, we tend to be optimistic in economics that those problems tend to get solved because we keep investing in R&D. The big challenge is we're a bit like the ancient Greeks pushing, Sisyphus pushing the rock up the hill. We know we need to keep at it. So we keep using our good methodologies in our RD&E space to try and find the best technologies, find new research, make sure we've got a balanced portfolio of blue sky versus, things that we continue to work on and, incremental gains, and get that balance right against risk, and make sure that we evaluate those projects, in terms of what the opportunities might be and weigh them up and get a good portfolio. That challenge hasn't changed. It'll continue to exist. And I'm very optimistic that we'll continue to find new opportunities and new technologies into the future that will help us.
Okay, thank you, Gavan. Mario, any further commentary around biological ceiling type effect from your area of investigation?
Sure, that is a very good question. That is something that has been also popping up around the conversations we've been having here with farmers or internally there in Z about the biological ceiling. And once that ceiling is reached, what is going to be the next step that we are going to take? Because that it's a natural limit that cannot be surpassed. There's nothing else that can be done. But we have to get back to the point that we're talking about a technology quantum. It is not just about one piece of technology that is going to push the production boundary. So we need to think in terms of the complementarities and the values that are going to be introduced by every investment decision that we may be planning, particularly the decreasing effectiveness of pieces of technology in relation to this biological limit. It has been mentioned the gene pasture, selective breeding, and other aspects that are currently under investigation. But I think Gavan just covered most of the aspects quite good. So.
Excellent. Thank you very much, Mario. We are to time, but I might just run us on a couple of more minutes because I think we can get to the questions here. There is one more which I might put to Gavan or Chris. I'll read it out now. So when exploring farm-level productivities, do you see expected trends in which farms are being identified as highly productive, in brackets, as a means of sense-checking results? Are there subpopulations of farms that have in fact made material improvements to their TFPI over time?
Yeah.
To you first, Gavan.
Yeah, good question. Look, across the board, we see relative consistency in the trend across a lot of different types of farm systems. So be they large, be they small, be they pasture-based, be they more intensive, etc. We see distributions between them, and you'll certainly see poorer performing ones in all of them, and you'll see stellar ones amongst them. The challenge is, I suppose, always is to learn what you can from it, but also be wary about benchmarking that too much, saying, if I could just do what that bloke down the road does, I'm in for mozza. Well, it's not always as easy as that. There's usually certain very specific contextual constraints to individual farms that mean they do certain things in certain ways. And some of those, some of that performance reflects what their values are, what their objectives are, what their, their cost of capital might be, all sorts of things, their skills, etc. So we've got to be careful that we don't try and find the magic mix that works, and if we can just find that farm system, then we're off and racing. We've got one of the beauties of the Australian system is that we've probably got a diversity of farm systems that, in a way, is a natural hedge against risk for our industry. That we've got circumstances which will benefit some of those types of farms in some years in certain ways, and in others in other years. So there's some farmers make really sensible risk-based decisions about how they move forward with their farm systems. We're going to be careful about drilling too far down into comparing what are the characteristics of individual performance of that. But I'll turn to Chris, whether he's got some views on that.
No, I've got nothing else to add. You've summed it up pretty nicely. It's true that, different farmers, they go about their business in a different way because they operate in different environments. They've got different soils, topography, different rainfall, temperature patterns. They face different prices. The environments in which they operate are different, and they sensibly adjust their production techniques to those environments, and that's why we get a lot of differences in productivity levels.
Well, thank you to both yourself, Gavan, and Chris on that one. Sadly, I think we might have to draw to a close there. We have exhausted our time together. If we didn't get to your question, we will come to you offline post the event in response to that. But that does bring us to the end of the session today. And thanks very much to all of you who have participated and joined us for the International Dairy Productivity Analysis event. So, thank you, Gavan.
Thanks very much, Jane. It's been great to be here.
To you, Mario, thanks so much for joining us from New Zealand.
Thank you. Fantastic experience.
Beautiful. And to Chris, thanks for joining us to share the US results from their report.
Yeah, thanks, Joe. It was a pleasure.
And Helen, I'm sure from everyone, thanks to Dairy Australia for bringing and putting this event together.
Thanks, everyone, for joining.
Okay, so to everyone, keep an eye out for all the upcoming Dairy Australia events via the website www.dairyaustralia.com.au. But from all of us, it's goodbye for now.